Okay, now to pick up where we left off, just to review a little bit of where the last video was. A lot of information, I know. You may have to watch it a couple times, but as you go through it and then you read what's in the chapter, and then maybe if you watch it again, I know that takes time, but I think it'll become more clear to you how this works, because there really is a rhyme and reason to it. So what we're looking at in this chapter is tracking the three manufacturing costs, the three product costs: direct materials, direct labor, and factory overhead, and charging those, keeping track of those by jobs. So I know how much a job actually costs when it's done. I can just total up all the charges, all the materials it went and got, as evidenced by material requisition slips, as well as the direct labor used on the job, as evidenced by an analysis of the time cards and where employees spent their time, as well as this more nebulous charge of factory overhead to jobs. And that's what we're going to focus on right now, is factory overhead. How do I record factory overhead? And how do I charge it to jobs? And this is going to be the tough one. When I take this amount and charge it to jobs, just by the fact that I am charging something to work in process, I've got to charge it to jobs. So let's start with this side over here. That's a little bit easier. And how do we charge factory overhead? Let me go to the text. This section actually starts up here, and it talks about taking it out of factory overhead before it talks about putting it in. That seems a little backwards to me. So we're going to talk about how do we actually record all these indirect costs that I'm incurring. Well, all the indirect costs are the indirect costs of the factory, including the indirect materials used. And we've already kind of seen this, but this entry just shows it's from the material requisition slips, and it just shows the indirect materials being taken out of the raw materials inventory. Let me go back to where they did this summary. They did a summary here somewhere. Here it is. That for a period of time, the total material requisition slip showed $2,350 taken out of raw materials. We addressed the direct materials in that we are going to transfer the direct materials from raw materials to work in process with this entry. Just take it right out of raw materials and put it to direct materials. But what about the indirect portion? Well, that's where they talk. Here's where they introduce that entry down here. Is the same entry I showed right here, the indirect materials used. We're going to take it out of raw materials and put it to factory overhead. Notice that's exactly what they're doing, crediting raw materials and to factory overhead. So just think about raw materials. There's two entries. We take it out of raw material. The direct portion goes to work in process, charge it to jobs. Indirect portion down to factory overhead. Indirect labor used. We talked about that already. That's the indirect labor. In my example, was this $3,500, and we charge the direct portion to work in process, but the indirect portion gets charged to factory overhead with this entry, which is the very same entry they have here. Debiting factory overhead, crediting wages payable. Same credit, payable, but just where does it go? And then recording other costs. Oh, there can be lots of other costs here. And the other costs, every other cost is debited to factory overhead, but the credit can be to various things. One could be accumulated depreciation. Now, think back to 4A, when I had an equipment account. Here, let me, I'm going to lay this out for you. And then there's rent payable, utility, prepaid insurance. Okay, hold on. Depreciation back in 4A. When I buy an asset, when I buy a piece of equipment, and I buy it for $100,000, we're going to reflect depreciation on that. And remember, we actually use one of three methods: straight line, double declining balance, or units of activity. But I'm going to expense that as I use it. And remember what that expense is called? It was called depreciation expense. So to keep it simple, we do keep the depreciation very simple in this course, because we don't want to complicate the matter any more than we need to. But if I'm going to use this piece of equipment for 10 years, at which point it'll be worthless, well, straight line depreciation says that, well, I'm going to burn up a $100,000 piece of equipment over 10 years. That's $10,000 a year. So every year I would want to expense $10,000 of it. And do you remember what the entry is? We debit depreciation expense and credit not the equipment account, but accumulated depreciation. We keep that separate, so we know what the equipment cost and how much of it I've expensed so far. Now, in our situation, we're a manufacturer. Remember, all the factory equipment and all the items in the factory that I'm depreciating, that doesn't end up in depreciation expense. Every factory expense ends up in cost of goods sold. So the depreciation on factory equipment is not depreciation expense, it's factory overhead. So when I calculate here that I've got a factory piece of equipment that cost $100,000, of which I want to reflect that $10,000 of it was burned up this year, well, then I'm going to not debit depreciation expense, but I'm going to debit factory overhead and credit accumulated depreciation. So that's why they say that in the entry to record factory overhead, the depreciation is not, we're not going to credit cash as we would a lot of these other ones as I pay them. We're going to credit accumulated depreciation. Prepaid insurance. Remember that another asset, if I prepay my insurance, prepaid insurance, if I pay my insurance, say for a year, $12,000, cost me $1,000 a month, so I pay it all right now, what we showed is prepaid insurance. Then every month I need to make an entry to expense what I've used. Back in 4A, we debited insurance expense for $1,000 every month to show that that's how much of it I burned up, and I credit prepaid insurance. But if this is insurance on the factory, we're not going to debit insurance expense. We're going to debit factory overhead and credit prepaid insurance. Because remember, this, if it's a factory item, we don't have insurance expense for the factory. It's part of factory overhead. So that's why in the chapter here, I'm not even going to pause it. That's why in the factory they say that in recording factory overhead, we're going to debit overhead for every single item. And the credit, a lot of it will be to cash because I bought stuff for the factory. A lot of it will be to accounts payable because I purchase a lot of things on account. But sometimes the depreciation, the depreciation will be a credit to accumulated depreciation. And here's like rent payable, utilities payable, prepaid insurance, just showing the usage of factory insurance. So the credits could be all over the place, but every single indirect cost of the factory goes into factory overhead. Here's the total indirect costs of the factory, excluding materials and labor, indirect materials and indirect labor. Oh no, not excluding, they're here. Factory overhead, the indirect costs were $3,900, $400 were indirect materials taken out of raw materials, $2,000 were indirect labor, $1,200 was the depreciation on factory equipment, and $300 was the utilities. And of course, in the real world, where's all the rest of the expenses of running a factory? You know there's hundreds of them, but yeah. Here they're just showing that for office equipment, for selling and administrative expenses, those period costs for running the factory, Remember, all the expense, not running the factory, the selling and administrative expenses, those still have depreciation expense and insurance expense and salary expense. That's what this is. They're saying, yeah, you still record depreciation expense on office equipment because that's not a factory expense. That was a selling and administrative expense. That doesn't change. It's only all these costs of the factory, including depreciation. So that's where that gets accumulated. That's how we build up the actual factory overhead costs, the actual costs. So now I'm going to do a fairly simplistic example so we don't get too caught up in the detail too much. We're talking about this third product cost. Of course, direct materials comes from raw materials. Direct labor is what we paid in direct labor. But where does this come from? Well, it starts all the factory overhead, the actual factory overhead costs are actually debited here as I incur them. And they can be indirect materials, indirect labor, and all the other indirect costs. And so I'm going to just keeping it simple. I've got 4 jobs going. These jobs they're all going to be charged with all the manufacturing costs. Okay. Requisition slips show that, hey, you know what? We used 30,000, let me do it this way, 30,000 of direct materials. 30,000 of materials came out of raw materials and got charged to work in process. Okay, well, 20,000 of it went to this first job, 5,000 to the next one, 3,000 and 2,000. Pretty big job. Maybe this one was started at the end of the month, but that's the 30,000 of materials that went directly to jobs. Those are the 4 jobs they went to. Direct labor was, I'll say, 50,000. Pretty intensive. Okay, well, 30,000 went to this job, 10,000 to this job, 6 to this, and 4 to this. That add up to 50. It's got to 30, 40, 6, 50. Good. So you notice that every time I add something to work in process, I add it to the job cost sheet because these are direct costs. They are direct. They are traceable to jobs. But all my other factory overhead costs, I'm going to say they added up to $100,000 for the month. $100,000. And I kept track of them all here. Now it's the end of the month. These are the 4 jobs I worked on during this month. So I'm going to make a journal entry to now transfer that 100,000 up to work in process. I've kept track of the overhead in a bucket. Now I'm going to dump that bucket into work in process. And because I'm charging work in process here, I need to charge that 100,000 to the 4 jobs I worked on. But it's got to be allocated. It's not a direct cost. It's got to be allocated. So now think about this. Do you think it would be fair to say, well, I worked on 4 jobs, and the total indirect costs of the factory this month were $100,000. Let's just charge $25,000 to each one. Now, at first, that might seem kind of reasonable, but it's actually not. And here's why. I might look at these jobs for this month. This is the month that I actually incurred that $100,000. And these 4 jobs I worked on, maybe I work in construction. So the first job was a pretty good size house. It was a pretty good size house. The second job, I worked on it, a little bit smaller. The third one was a little bit smaller, and the fourth one was just a little doghouse. Just a little doghouse. Now I worked on this all month long. This one I only worked on for 3 days. because it's a small job. So of course that's why going from the extremes, that's why this one cost $20,000 in materials and this one only cost $2,000 in materials. Hang on. So it doesn't make sense to charge $25,000 to each job. Would you agree that we should probably charge this $100,000 of indirect factory costs to the jobs that I worked on during this period in relation to the size of the job? And that makes more sense. Big jobs we work on all month long, little jobs don't take too much time. We should actually charge bigger jobs with more of the indirect costs, because wouldn't you agree that if they take longer and they're larger, they're actually consuming more of the factory overhead, that more of the factory overhead is being incurred for the bigger jobs than the smaller jobs? Because certainly a little doghouse shouldn't have $25,000 of factory overhead in it. Maybe it should only be a couple $1,000s, and then this one should have maybe half the factory overhead if it took half the time. So that's what we're going to do, is we want to allocate the factory overhead to jobs based on the relative size of the jobs, based on the relative size. So generally, larger jobs have more overhead. Smaller jobs get charged less overhead. So that's what we want to do, is we want to allocate it that way. But how should we gauge the size of a job? How can we objectively say, well, how are we going to measure the size of a job? So the way that it's generally measured in practice is like this. Now you can imagine that we could probably measure the size of a job by the number of days that it was worked on. That might be, yeah. We could do it maybe based on the amount of materials that was in each one, the relative amount of materials. I guess that's a way we could do it. We could do it based on maybe the square footage of a job. But the most common way that we do it is based on this: relative direct labor in a job. Relative direct labor, which is based on that. So we could say this. We could say, well, we know that these jobs took $30,000 of direct materials, broken down by that, and that's a hard cost. The direct labor that was spent on jobs, it was broken down like that. And we could say, well, of the total direct labor, the total amount was $50,000. $30,000 of it was to the first job here. This $50,000 is these four. $30,000 was to the first job. That represents 60%. 30 of the 50,000. 10 of the 50,000 went to the second job. 6 of the 50,000 went to the third job. What is that? 6. That is 12%, right? 6 of the 50, and then finally 4 of the 50 is 8%. 4 of the 50. So that's 100%. So the manufacturing environment has recognized that direct labor is probably a pretty good measure of the size of a job. How much labor is it? Small jobs will have a little bit of labor. Large jobs will have a lot of labor. So now we could use that percentage to allocate the $100,000. We're going to allocate factory overhead to jobs based on relative labor. Well, if job A had 60% of the total labor, it should get charged 60% of the factory overhead, which is $60,000. Job B had 20% of the factory overhead, so we should charge it 20% of the factory overhead, 20. C had 12% of the factory overhead, so we should charge it 12,000 of the labor. Finally, D had 8% of the factory overhead of the labor, so we'll charge it 8% of the factory overhead. So now we've got a more realistic allocation of factory overhead. Bigger jobs, as represented by direct labor, gets charged more factory overhead. Smaller jobs, as reflected by direct labor, gets charged smaller amounts of factory overhead. So it does. It makes more sense that we could allocate, we could tie factory overhead to labor. So we're going to recognize that relationship, that factory overhead is going to be charged to jobs based on relative direct labor costs in each job. So now, we're not going to make this allocation each month. What we're going to do is we're going to recognize this, that throughout a year, we want to track the factory overhead for the entire year. This is January, and this is December, because I don't want to. It's hard to see at this point right now, but various factory overhead costs are cyclical, which means that utilities may be higher in some months and lower in others. The utilities may be higher in the winter, or I'm sorry, in the summertime when the air conditioners are running, and so. But throughout an entire year, everything kind of smooths out. So we want to really track our factory overhead. We're gonna keep track of our factory overhead for the entire year, and maybe the actual overhead that I'm going to be charging to here. I'm going to keep track of it, and maybe for the year it'll turn out to be $1 million to $1 million. Now I want to charge that factory overhead to every job I work on. So, and I'm just going to say that we're going to have a lot of jobs. Some are going to be bigger than others. Some are going to be relatively small. Some are going to be really dinky. Some are going to be. So we're going to be working throughout the whole year on various jobs. Some are bigger, some are smaller. And I want to charge my factory overhead to these jobs based on the relative amount of direct labor. So we're going to keep track of actual factory overhead, and we're going to keep track of course, actual direct labor. And actual direct labor worked out to be, and so we're tracking it. And let me just put the direct labor in here. Oh gosh, maybe I'll say, I'm going to pause it just for a moment to work out the numbers so they work out well. So, okay, so we have kept track of factory overhead throughout the entire year, and it turned out to be $1 million. That was the actual factory overhead, all the indirect costs of our factory. And we have tracked the direct materials and the direct labor of the jobs we worked on. And the direct labor, actually I put what the direct labor amounts were here. And you can see that big jobs had a lot of direct labor, little jobs had a little direct labor. And so direct labor is a pretty good indication of how big a job is. So wouldn't you agree that of this $1 million of actual factory overhead, a lot more should be charged to this job than to this one? No question about it. Big jobs get charged a lot, little jobs get charged a little. So we're gonna come up with a rate. I need to know what my rate is. This is an overhead application rate. Now, I want to compare my factory overhead, my total actual overhead, to my total direct labor, and if we add up direct labor, total overhead, or total labor, those all add up to $500,000. Now remember, we're tying overhead to labor. We're coming up with that relationship. So we're going to come up with our rate. Our overhead rate is a function of, and it's right here in the book, It's overhead cost divided by what they call an activity base, which is labor. Labor. And if you do this on a calculator, if you take $1 million divided by 500,000, that's going to come up with 2. 500,000 goes into a million twice. Now, it's not $2. What it is it's a percentage. When you divide a dollar amount by a dollar amount, the answer is not dollars. Those cancel out. The answer is a percentage. Comes up with 2, so move the decimal place 2 places to the right. It's 200%. Can you see that factory overhead is going to be twice as much as labor? Factory overhead is 200% of labor. That is true. It's 200% of the labor. So, given that now we have a rate. My factory overhead is going to be 200% of labor for the year. That's what it is. So, now, when a job gets finished, this job was $40,000 of direct labor. How much factory overhead will I charge it? 200%, $80,000. How much factory overhead should I charge to this job? 200% of its labor, $200,000. Every job, because in total, factory overhead is going to be twice as much as labor. In every single job, I should charge twice as much factory overhead as it has in labor. So, when it's all said and done at the end of the year, direct labor equals 500,000, which is what it was. And how much factory overhead have I charged to jobs? 1 million. Big jobs got a lot of factory overhead. Little jobs got a little factory overhead. Medium-sized jobs got a medium-sized factory overhead. So that's what we're going to do. So at this point, just lock in this concept that I'm going to find the percentage. I'm going to come up with a rate which represents what my factory overhead will be compared to my labor. And this may be less than 100%. If actual factory overhead, if the factory overhead is only going to be 500,000 and direct labor is going to be 2 million, 500,000 to 2 million, you divide that, comes up to 0.25. Move the decimal place 2 places, 25%. Oh, my factory overhead for the year turned out to be 1/4 or 25% of direct labor. So if I have a job here that took direct labor of 40,000, how much factory overhead will I charge to it? 25%. Or 10,000. Yeah, that's my rate. It's factory overhead divided by direct labor. Total factory overhead divided by direct labor. Find out what overhead's going to be in relation to labor in total, and then on every job we're going to maintain that same ratio and charge out my overhead based on the labor cost. That's what we're going to do. But now we're faced with another challenge, and that is in the timing of this. So let me do this. So here we are. I'm the accountant for a business, and I need to charge out jobs. I need to calculate the cost of jobs. And so here we are at January. Here we are in December. And maybe in January somebody comes in, wants a job done. It's a relatively small job, but they want a job done. So I open a job cost sheet like I do with every single job. We've got direct materials, direct labor, and we're going to need to charge it with some factory overhead. This job is actually going to be finished. We finished this job on January 17th. Do I know how much materials was used on that job? And the answer is yes. We've got direct material requisition slips. When we worked on this job, we went to the raw materials inventory. I've got requisition slips that shows that we used $10,000 of materials. Do I know how much direct labor cost was? Yeah, based on the time records, on the payroll records for this month, looking at how many hours people spent directly on the job, working on this job, maybe direct labor turned out to be $12,000. Good. Factory overhead. How much factory overhead do I charge to it? Well, factory overhead is going to be a percentage of labor based on the rate. But now think about it. What's my rate? What is my rate? I'm going to have to wait all the way until December, until the end of the year, so I know how much my total factory overhead is and how much my total direct labor is, aren't I? Because we said the factory overhead application rate is what? It's total factory overhead divided by, I'm just putting this one same place, total factory overhead divided by total direct labor cost equals some percentage. And that's the percentage I'm going to use to charge jobs. Well, when am I going to know total factory overhead? Not until December. And when am I going to know total direct labor? Not until December. So, are you telling me, Keith, that we're not going to be able to figure out what this job cost that I finished in January? I'm not going to be able to figure out what it costs until December? That's kind of unacceptable. I can't wait 11 and a half months to find out how much overhead we're going to be allocating to jobs and the basis on which to do it. But recognize this. Do you think that on January 1st or even in December prior to January 1st, do you think companies they know about how much their factory overhead is going to be for the year? Do you think they know they can guess pretty close to how much the rent's going to be for the year, and how much their utilities is going to be, and how much their repairs are going to be, and how much their indirect labor costs are going to be? And the answer is yes. That's budgeting. Back here, they're going to prepare a budget. They know about how much their factory overhead is going to be. They have a pretty good idea. It's not exact, but they've got a pretty good idea back here. So I'm actually going to use not actual factory overhead, but I'm going to say that we've estimated that total factory overhead, we've estimated that it's going to be $400,000. And I'm going to put that in just kind of a dotted around, because that's our estimate. It may be 390, it may be 410,000, but we think it's going to be 400,000, and we won't be far off. Likewise, do you think companies know about how much their direct labor cost is going to be? Do you think they know direct labor cost? And the answer is yes. They've budgeted for direct labor as well. They know how many employees they have. They know what percentage of their time is going to be spent working on jobs. They've got that. So we're going to say that the estimated direct labor is going to be 800,000. It may be 790, it may be 810, but we think it's going to be around 800,000. So we can come up with a rate way back here before the year even starts. Before the year even starts. And this is called a predetermined overhead rate. Why is it predetermined? Because we're going to calculate what this rate is. We're going to calculate the relationship between factory overhead and direct labor before the year even starts. And in this case, estimated factory overhead is going to be how much? We think it's going to be $400,000. And what is my estimated direct labor? $800,000. These are estimates, but they're close enough because factory overhead's an allocation as it is. We're just using estimated numbers. 400,000 divided by 800,000 is 0.5. Move the decimal place over, it's 50%. So, we think that for the year, my factory overhead is going to be half of my direct labor. Factory overhead we think is going to be 400,000. Direct labor we think is going to be 800,000. So our rate based on those estimates is 50%. Factory overhead is half of labor, 50%. That's my predetermined rate. And in the text, that's what they said here. The predetermined overhead rate is estimated overhead costs to come divided by my estimated whatever I'm tying it into, which is direct labor. So now, we know this rate. We know this 50% rate way back here. On January 17th, I finished a job that took 10,000 of materials. It took 12,000 of labor. How much overhead should I charge to it? Well, the predetermined rate says that overhead should be half of labor for the year, 50%. So now I can charge out this job. Half of the direct labor, $6,000. This job now cost, what does this job cost? $28,000. And I can finish it. I know how much money I made on it right now. I don't have to wait till the end of the year to get these actual numbers. I have another job that I start. It takes direct materials of 25,000, direct labor of 30. How much factory overhead should I charge to it? 50% of the labor, which is 15,000. So now this job, when it's all done and complete, I don't have to wait till the end of the year to get the actual numbers. I'm using the estimates. Now this job costs 70,000. Now when we get to the end of the year, are we going to hit these numbers right on target? Are these going to be right on target? And the answer is no. But that's okay because it's going to be close enough. When we get to the end of the year, suppose that I start recording during the year factory overhead, actual factory overhead. Now remember, I thought it was going to be $400,000. Suppose it turns out to be $410,000. Oh, it was actually a little bit more than I thought it was going to be. So this turned out to actually be 410. Now, this job, or direct labor, I thought it was going to be 800,000, but it actually turned out to be 810,000. Well, if it turned out to be 810,000, how much overhead? Now, this is what's called applied. This is going up to work in process. Just like we said here, this is actual, and then this is what I'm charging to jobs. It's called applied. This is factory overhead applied. And I'm applying it based at a percentage of actual direct labor. Well, how much did I actually apply here? Well, I had 810,000. You don't stop when you get to 800. Had 810,000 and I was charging 50%. I actually charged, what is that, 405,000? Because actual direct labor turned out to be 810. 810,000. 810 was charged to work in process. So I charged 50% of that. I took 405 out of here and charged 405 to various jobs, because the direct labor in all these jobs added up to 810. So I charged 50% of that to all these jobs. So at the end of the year, we would have recorded actual factory overhead of 410,000, and we would have charged to jobs based on that percentage of direct labor. I would have charged or applied 405,000. What's the balance of this account? We put 410 in, we took 405 out. It's got a debit balance of $5,000. Now think about this. Am I over or under applied? Did I apply too much, or did I apply not enough? Now, had I known what factory overhead was going to be, I would have charged 410,000. But I didn't know. I worked with estimates, and it actually came out the actual overhead was 410. I charged to jobs 405, 50% of direct labor. I'm under applied. There's still $5,000 that didn't get charged, but that's okay. That's okay. That's like a 1% difference. And in the meantime, I figured out what the costs of jobs were as we finished them. And every year I'll just clean this up. I'll talk about that in the next video. But so really factory overhead is I'm just charging the actual here, charging actual overhead. I'm also pulling it out, charging to jobs when they're done, and at the end of the year, I'm either going to be a little under applied or a little over applied, and I'll clean that up later. But what we want to recognize at this point in the game is just that we need to come up with a rate at the beginning of a year, a rate at which to charge overhead to jobs when they're done. And that rate is going to be a function, it's going to be a relationship or a ratio between what we think the total overhead is going to be, estimated overhead, and what we think total labor is going to be. We find out what that percentage is, and then we just charge jobs as they're completed based on that percentage. We'll end up off a little bit, but that's okay. That's what we're going to do. Okay, now that's the entire chapter now. That is the entire chapter. I want to go through an example or two with the whole thing so you can see what's going on. So you can see, kind of pull these units all together, pull these concepts together so we can see what's going on. And that's what the next video will be. And I'm going to load that later today. So with that, hopefully by the time you start watching these, they'll probably all be there. But take your time with this. Watch this a couple times if you need to. I think the next video showing how it's done, putting numbers to it, is really going to be beneficial. So anyway, finish this one up and move on to the next one.